FirstRand's first half diluted earnings per share rose 9% to 101 cents, helped by a decline in bad debts and high income from loans. South Africa's second largest lender by market values, net interest income, a measure of earnings from lending, rose 22%. Group bad debts for the 6 months ended December 31 fell 12%, but non-interest income, which includes fees and commissions, was little changed. FirstRand declared a dividend of 44 cents. Let me begin with you, Anthony, here in Johannesburg. When you look at those numbers, the number that does sort of jump at you is, of course, that bad debt number, and also the increase in earnings from lending, up 26%. What were the other top liners for you?
Well, I think you're absolutely right. The key takeaway from this set of numbers is the strong net interest income growth of 22%. Really on the back of strong advances in their vehicle financing businesses and unsecured lending. And also in the asset margin expansion. So they're taking on more risk, they're able to charge more money for it, and they're extending more credit at the same time. And that's where really the 22% growth in net interest income has come from.
Yeah. If I can come to you, Craig, in Cape Town, when you look at the environment that we are in, we've got interest rates at 3 decades lows. So it does make sense that the bank is making more money out of advancing borrowers their money. But when you look at those numbers, is that the quantum that you're expecting? Could they have done better, do you think?
Yeah, well, look, as you say, interest rates at 3-year lows. They made an interesting comment that every basis point increase translates to about 360 million rand to them. So, of course, if interest rates turn up, that's what you can sort of expect as an effect. But I think it's pretty much more or less expected. There were a few surprises. I think one didn't think too that vehicle asset finance would have such a great extent, a 58% increase in profit. I think their return on equity was about 30% as opposed to the group's 19.5%. So certainly a good contribution there. We did expect unsecured loans to increase. I think the increase was around about 30%. And that's in line with the strategy of most of the banks, looking more at the smaller end of the market and the unsecured loan side. But there were a few surprises and concerns, I suppose. The one was what they call FICC, which is fixed income, currency and commodities. There was a 1.5 billion rand amount there that obviously is an IFRS situation, and in this particular 6 months it was in their favor, but these things can swing. You know, the rand was 8.15 rand at the end of the 6 months to December. It can quite easily change, and so there were a few little things that concern me, which make the current set of results look good, but could change things. You know, 1.5 million off a 5.7 million rand revenue is a significant amount, or 5.7 profit rather, significant amount. But
what about the venture into the unsecured loans market? When Anthony was speaking, I was watching him very closely. He seemed to be slightly, he didn't quite come out as strongly as I expected when he was talking about the unsecured lending. Is that a venture that's full of risk there? Also, we're looking at 3% of their total loans now being to that market. Is there a target here that we should be watching?
Well, you know, that they indicated that a lot of that unsecured lending is in the F&B card space. So they sort of indicated that we shouldn't be too concerned about it. The rest is to do with your low-cost housing side. And of course, you're going to look at some unsecured lending as they expand into the African market more and more and understand that market. So it's about 6% I think of the total lending. So it's certainly an area that'll grow, and not something that's too surprising. But in my mind, it is a little bit concerning, because I think a lot of the banks are a bit late to the party, and one wonders what the quality of the books that they're accumulating will be 3 years down the line.
Yeah. Anthony, did I read you wrong about that unsecured venture, in that you seemed a little uncomfortable, or are you okay? 3% of the total loan book, it does sound like a small number.
Yeah, I think it's the rate of increase that is quite noteworthy. We think that we're probably in the early stages of an unsecured lending bubble in this country.
Yeah.
We're seeing the likes of Capitec, the likes of Able, kind of massively massively extending extending credit, trying to gain market share. And eventually, I think that they will have to kind of lend money to less and less quality borrowers, and I think eventually that kind of impacts profitability to a massive extent. We saw the kind of subprime lending fiasco in the States when Unsecured lending was taken to an extreme. We think that, it is understandable at this stage in the cycle that this is where the kind of growth and extensions would be.
Yeah.
There's little demand for mortgages. There's still a lot of non-performing loans in the mortgage books.
Yeah.
So it's understandable that this is the area where extension will be, credit extension will be. But we are concerned about the quality of the business being written in those unsecured businesses.
Yeah. My other 2 points that I wanted to make and actually ask a question around, it's one is on Westbank. We saw that profit after tax up 58%, number one. Number two, we also saw the non-performing loans down 1.4 percentage points, down to 3.7%. And bad loans as a whole down 12%. The key question from me is that sustainable, do you think?
Yeah,
for those two units.
I think that as the economy improves, you'll start to see non-performing loans or the write back on those provisions for non-performing loans improve. And I think that that's understandable. Is it sustainable? I think yes. I think they will be able to continue to write back more and more of these provisions as the economy improves. I think the other notable takeaway from these results was the very good cost containment. They only grew costs by 9%. The cost-to-income ratio was essentially flat at 56.4%. So I think that's very commendable. The management is doing well. Yeah. We think that FirstRands is probably the most innovative bank in terms of the way they've re-engineered their business, the way they are advertising, the way they're using technology. I think it's very encouraging to see. We think they've got the best quality management team of the top four banks. We think their growth strategy of being the predominant financial services group in South Africa, with then strategically cherry picking growth markets in Africa and trying to get gearing on the increased trading activity between Africa and India and China. We think it's a very well thought out strategy. Yeah. And we think overall management at this bank is doing kind of quite well. I
was very interested that you mentioned the fact about some of their advertising being very, very innovative. At the same time, there's that row with Standard Bank who are suggesting that FirstRand is being a little bit misleading with the truth here. But I always say that Steve is a very bad salesman because he can't be shut up by people that he's trying to sell money to. But Craig, let me come to you. When you look at acquisitions, Sizwe is talking about potentially using about 10% of his capital trying to find acquisitions in Africa. He says they will be small and they will focus on organic growth. But that venture into Africa for you, where should he be? Is he late?
Look, I don't think he's late. I think it's quite interesting that that's exactly what his statement is. They want to be the best financial service provider on the African continent. Standard Bank had that vision and then lost a bit of focus. So I think maybe the timing's not a bad thing, but there are challenges. There's changes in legislation. I think one of the questions in the announcements came around Zambia and the challenges there in terms of the capital requirements of banks. You've got Basel 2.5 and Basel 3 coming out. So it's certainly somewhere that they should be looking at, and I'm comfortable with the fact that they want to grow on the African continent as opposed to Europe, Asia or any other areas. And if they can contain costs while doing so like they've managed to do here, then I think it could be a good story.
Certainly that China-India leg is one that they are touting and also getting to the African continent. But here in South Africa, one of the key issues that I saw are coming out of those results is that they are saying that the corporates here are cash flush and they are not borrowing from the banks. Do we see some kind of light coming out of the tunnel on that front?
Are you asking me, yeah?
Yes.
Yeah, look, I think the indication was that corporates are pretty flat, but there's been quite a change in terms of some of their group strategy, because a lot of the RMB focus, and there's been some absorption into that particular group. So I think this particular 6 months, there's been a change in corporate focus, and maybe they've had to bed down that change in focus as management readjusts to the way going forward. I think we're going to see improved growth on the corporate side of the business as opposed to the retail. But what's quite interesting on the retail side is there's also been a change in product mix. I see it with a lot of the banks, and FNB included, that mortgages, just like in Europe, is not really part of their focus. And so it'll be quite interesting to see what sort of products come out into the corporate market, because I think there's going to be some innovation that may be around the corner there.
Sure. So the question for you that comes is then that you sound like you do like FirstRand? Is it time to get into the banks? Is it hot for you?
Yeah, I am concerned about some of, as I say, those IFRS numbers there, but out of the 4 banking stocks, FirstRand I think is the most innovative, and from that point of view it would be my choice, followed by Investec.
FirstRand is hot, followed by Investec. Anthony, for you?
Well, the stock has run hard, but up 20% over the year.
Yeah.
So we think that we're kind of mediocre. We've got a hold on it, basically.